And now to some consumer news. Mortgage rates are below 6% for the first time in 3 years. Now, as rates drop, home buyers may be wondering whether they should refinance their mortgage and lower their monthly payments or not. Jenn Sullivan looks at the pros and cons.
Mortgage rates are starting to come down. For the first time since 2022, the average 30-year fixed mortgage rate fell to 5.98%, according to Freddie Mac. So if your rate is higher than that, should you think about refinancing?
I typically tell people that you need to have at least a percent or more in terms of the gap between what you have and what you could have.
Stephen Cates with personal finance site Bankrate says home buyers whose 30-year fixed mortgage is at 7% or higher may be good candidates for refinancing. Even a small change in your interest rate can save you thousands of dollars a year depending on your loan. But he says you really need to look at how much you'll be saving each month with a lower rate and what it's going to cost you to refinance, because it's an expensive and timely process.
Your new mortgage, your refinance, even if it's with the same bank, is essentially an all-new loan that pays off the old one.
There may be multiple fees associated with refinancing, like all of these closing costs. Bankrate estimates it typically costs you between 2 to 6% of the new loan amount. So if you're refinancing a $300,000 mortgage, it could cost you between $6,000 to as much as $18,000.
The lower you can get, the easier it's going to be to see those savings in real time.
Kate says you don't have to refinance with your current lender. And because of that, he suggests shopping around for the best rate.
All right, and one last piece of advice for you. You want to make sure your credit score is good. The higher your score, the lower your rate.